Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 9. In my previous video, people posted some comments about issues with audio, so I've tried to fix that. I'm not an expert at this, so please let me know in the comments if this video is better. If not, I'll try again. If it's obviously good, we're good to go. Anyway, let's jump into today's video. Today's video is Lesson 9 of ICT's 2022 Mentorship Program. And our outline for today's video is going to start with ICT's power of three. We're only really going to look at the bullish version of this. And we're going to use a trade example using the NASDAQ from the 14th of February from the daily right down to the 2-minute chart. And the last part of the video will focus on afternoon session opportunities. And for that part of the video, we'll be using a trade example from the NASDAQ again on the 15th of February on various time frames. So for context, we're going to start with the daily NASDAQ chart. And as you can see from the chart, we're really looking at this period from about the 24th of January to the 14th of February. Now you might ask the question of why are we looking at particularly at this area and why have I marked it out with the fib? Well, this low here, you can see has actually penetrated this sell side liquidity here. So it's taken all this sell side liquidity out of the market down here before trading higher. And this is obviously the highest point in that particular range. So if we run our fib from that low to that high and we use that 50% level, that gives us our range, and that obviously sets out our premium part of the market in the range and our discount. So you can see after we penetrated that sell side liquidity down here, we then traded up from a discount into a premium, back down to the bottom of that premium range near equilibrium, back up into premium again before coming down into a discount. We didn't take out those lows again, so we closed above those lows, and you can see this particular candle here is an indecisive candle, sometimes called a spinning top. Basically, the open and the close are very close together, and you can see there's an extended range from the high to the low. So that's an indecisive candle before we had this explosive move to the upside on the 14th. And this is very common for an indecisive candle. Once you get a break either above the high or the low, you generally get a continuation. And you can see, as we've talked about in many other videos, when we mark out the range, often at that 50% level, we'll see an imbalance, and that's exactly what we've marked out here with the blue box. We've got imbalance or a fair value gap right there, and you can see the market from that spinning top, that indecisive candle, has traded right back into that zone. So before we go into any more detail about our setup on the NASDAQ, this is a good time to talk about the power of three. Now, we're not going to go into a lot of detail about the power of three here. We're just going to talk about the bullish version of that, and I might do a more detailed video of the power of three at another time. So if we're bullish, what we're expecting on the day is for the candle to open pretty close to the lows of the day, then trade lower before trading higher, and then closing below the high of the day. So that's what we're expecting when we have a bullish bias. And so what the power of three describes is the underlying thesis, if you were, for how that candle is formed. So we have obviously three steps. So we have accumulation, manipulation, and distribution. And so how that works is we have obviously the opening of that candle, and this is where our accumulation phase begins. So we have, in the case of a bullish candle, we have the accumulation of long positions, which start at and around the opening price, and obviously any point under the opening price. And after that, we're obviously expecting a push lower. Now this push lower should create a significant low for that session. And this is the manipulation or the engineering of liquidity. So you would recall in previous videos, we often talk about a push lower, which takes out that sell side liquidity. So that's what we're talking about here. And in this instance, we're expecting it quite soon after that initial open. Now, this initial move is important because it creates the counterparties for smart money to get set to go long. So remember, we're pushing down into that sell side liquidity. It's triggering those sell stops, which is creating those counterparties, those sell side, for the smart money buyers to get set. So it's an engineering liquidity for that smart money or that institutional money to get set, and that obviously allows them to buy at a discount. And so what we see is sell stops being paired with buying interest. And this also has the impact of neutralizing long equity. And so what that means is often, especially if there's been an overnight move, people will maneuver their stops to protect their upside as, you know, trade has gone in their favor. And so this move also takes out some of those long positions that may be sitting in profit, which otherwise would have continued to be profitable. So it neutralizes that long liquidity. And so this completes the accumulation and manipulation part of the session. We obviously have the market then trade higher over the course of the day. And then what you're going to have is distribution. So this is where those long positions are looking to exit. And again, this can be engineered by a push into that buy side liquidity. And this is where you have those long positions being paired with pending buy interest. So basically we have long positions being paired with buy stops. So we obviously have long positions that they need to sell, and those buy stops are going to create the counterparties for those long positions to exit. So that's a really brief summary of the power of three using a bullish example. Zooming in now to our 15-minute chart. Now, there's quite a bit going on the chart, so I'll just run through what's going on in the background in case there's any confusion. So what I've done is I've left the range on from the daily chart. So you can see this whole period of price action here is still in that discount zone. So that's below that 50% mark on the fib. So this is all in that discount zone. Obviously the green is the premium. And this is the fair value gap, which is formed on the daily chart. Now, the thing to keep in mind, or the thing to remember, is that this fair value gap won't actually complete until the end of trading on the 14th. So this fair value gap doesn't actually exist, but it just gives you an idea of how this fair value gap is forming as this session on the 14th of February comes to a conclusion. So I've marked out, now remember we're using New York time, we're always using New York time in ICT system. We have the beginning of the session here at midnight on the 14th of February, and then we have 8:30 marked here, which is what ICT uses as the open. And you can see I've marked out here the opening of that candle, which is what ICT uses as his opening price for the morning session. And so you can see prior to that 8:30 open, we've got this big imbalance here, this big fair value gap, which is formed. So that's obviously to the left of that 8:30 open. We also have an order block here as well. So remember, bullish order block is when we have consecutive down close candles. So you can see we have two down close candles here prior to an imbalance. And so if we're going to use the order block as our entry method in this trade, and you can see that actually works as the market trades back into the fair value gap and hits the order block entry, which is the open of the first candle in those consecutive candles of that order block. So that's it on that line there. And so what you can see is the market obviously trades down in the overnight session, trades lower prior to the open, it trades higher here, so it takes out these previous highs here. Now you often hear ICT talk about relative equal highs and how these are generally seen as suspects. So you would anticipate that the market would trade through these previous highs before coming back lower. So we'd anticipate that price is going to come back lower and it's going to trade back into this fair value gap, and then hopefully trade back in to hit our order block entries. So we have a lot of confirming evidence, which gives us a high conviction to look for a long trade to support our bullish bias going into the afternoon session. And so if we zoom into our 5-minute chart now, and keep in mind that power of three that we talked about earlier, accumulation, manipulation, and distribution, is we can see that sort of in action here. So we have our opening price, we trade lower. So this is our accumulation and manipulation phase. So this low is lower than this low here. Remember, this low needs to be significant as part of that power of three. And that occurs before price then trades higher. And then we have that distribution period at the end of the session. So as we mentioned on that 15-minute chart, we've got a number of factors which confirm our bullish bias and give us a high conviction going for a long entry here. So we have our fair value gap forming before 8:30, so you can see that here. The market obviously trades higher, lower back into that fair value gap, and we also have our order block entry triggered here. Now you can still see those consecutive down close candles. This is an entry based off that 15-minute chart, but you can see if you're going to use the entry on the 5-minute chart, it would be just slightly higher here. So if we're looking for a tighter entry and we're looking to get set, it would be in this particular period here. So this is going to be into our afternoon session. So remember that ICT talks about his afternoon session being post 1 o'clock, so after that lunchtime. And so what we would do then is we would zoom into this area and see if we could find a fair value gap set up as we hit this significant low and tag our order block entry in here. Now, as has happened before, my data can't go back far enough to a 1 minute chart on the NASDAQ, and I can't even go back that far. So I'm using the index and a 2 minute chart. But this is the area of interest you can see here. And whilst the fair value gap doesn't really set up as neatly as it does on a 1 minute chart, you can see the move here. So basically, this is the short-term high that we have prior to that imbalance. And then we have the move here, which breaks market structure, and a fair value gap is actually formed here, and then we're able to get into the position as the market trades back into it here. So if you do have access to a 1 minute chart, if you look at this period around 2 o'clock here, there is a setup on that 1 minute chart. And equally, as often happens, is that there's more chances to get set in the position. Now you can see it very clearly here on this 2 minute chart that after this fair value gap set up here, and it actually, this whole move actually trades back into that fair value gap that would have formed here, is that we have another fair value gap form. It's just not as tight an entry as the one we saw here, but we have our typical setup in terms of a bullish fair value gap. So we have our 3 candle setup. So 1, 2, 3, a fair value gap is formed between the high of the first candle and the low of the third candle. It obviously crosses the body of that second candle, and we need the market to trade back into that fair value gap to get set. And you can do that in lots of different ways. You can use a limit on the low of that third candle, or you can have your limit set in here. And you can obviously use an order block entry if you want. In this case, that wouldn't have been hit. But we have our break in market structure because this explosive candle to the upside breaks this short-term high here. And so if we were looking to exit from this position, assuming we got set down here in this 2 o'clock period prior to the end of the session, there's a number of logical places we could look to exit. So we have these bearish fair value gaps which have been formed as the market traded back into this fair value gap. So you can see if we had gotten set down here, there was an opportunity to get, an easy sort of 3-hour return. And if we even waited till we traded up into this second fair value gap up here, well, it's actually the third fair value gap up here, so towards the top of the range up here, you could see we could have even got about a 6-hour return. So there was quite a good opportunity to get a good return on trades from this setup, even though we didn't have a big explosive move after the setup in that fair value gap towards the end of the session. So moving on to the 15th of February now, you'll remember that the 15th was that explosive candle to the upside, which breached the high of that indecisive candle, that spinning top, to trade back into that fair value gap that was formed after the session on the 14th closed. And so you can see on the 15-minute chart the formation of that move here. Now, interestingly, with this move, you can see we had a consolidation from midnight leading into this ICT kill zone. So remember, that's the 2 o'clock to the 5 o'clock session. And the majority of the move was made in that London session. So you can see nearly all of that move has happened here. These explosive candles to the upside before some consolidation to the side, even going into that morning session. So even if you've been trading a short period of time, you'll know that chasing price is always a bad thing. It always leads to bad outcomes. And so this is a really good example of that. You should have this big move in the London kill zone session. So in that London session leading into the morning session in New York here. And obviously a lot of traders would see this move. They'd have FOMO, they'd feel like they've missed out. And coming into this session, lots of them would be looking to get long. And invariably what you see is the market pulls back and a lot of those traders end up getting pushed out of those positions. It's very easy to get caught up in the emotions of this kind of scenario where we've had a big move overnight and just get caught over trading this kind of period, and it's easy just to put way too many trades on and just, really chop up your account. And so the thing to remember is there's always opportunities for trades. And so the best thing to do, and using this case as an example, is to wait for the afternoon session. We have a bullish bias. We've had the market trade up into that fair value gap. And so we have an expectation of higher prices. And so it's just a matter of letting the market come to us and waiting for the right setup to occur. So if we zoom into our 5-minute chart now for the 15th, we'll just run through what we're looking at on the chart here. So you can see we've got our setup we're expecting into the afternoon session. And so if we just run through, we've had the market trade up into this fair value gap that we're looking at on the daily chart, and our range is still in place. So we still have our discount zone here and our premium zone above here. So obviously, if we can get set into the afternoon session on the 15th and do that in this discount zone, that's obviously what we're looking for. So if we look to the left here, so prior to our 8:30 open, and you can see we've got our opening price here. Now to the left here, we have this significant low here, and this low is significant because it resides just above a fair value gap. And so you can see we have this fair value gap which is formed here, and if we run that all the way to the right here, you can see this entry is then created here at around sort of 1 o'clock. And even though we don't have a fair value gap here, we can expect that price will continue to rally into the end of the session. Now, that's partly because we haven't run into this buy side liquidity up here. You can see we have these relatively equal highs here, but even as the market traded up, it didn't pierce this liquidity here. It traded back down into this sell side liquidity before trading higher. So just remember that power of three that we talked about earlier. We're expecting higher prices. So we have our opening price. This is where our accumulation is occurring. We have a manipulation. So we're expecting price to come down lower. So we're having that matching of long positions to the sell stops down here. So having these long entries being paired with sell side liquidity prior to that run higher. And again, in terms of the exits, we'd be looking at that distribution which would be occurring up inside this buy side liquidity, where those long positions would be looking for those buy stops again to create the counterparty for their exit. So if we zoom in now to our 2-minute chart, again, I'm using the NDX because I don't have the data for the NASDAQ, but this gives us a pretty accurate picture of what the NASDAQ would have been trading at. We have this run down into the sell side liquidity here just before 1 o'clock. We have no reason to expect that price will retreat lower. Obviously could, but we wouldn't expect it to, because these overnight stops have already been run. So we wouldn't expect price to come lower, we're expecting price to go higher. And so what you can see from the remainder of the session, there's multiple opportunities to get set. And so we can use that fair value gap or a combination of the fair value gap and order blocks as our way to get set as the market trades higher into the close. So if we look at this first position here, we have this short-term low being formed and these relative equal highs formed above it. So again, price is unlikely to trade below this new short-term low, but it is likely to trade below these relatively equal lows because they're quite suspect. And you can see that's exactly what happens here. The market trades back into that zone. And again, our fair value gap, this is bullish fair value gap, is formed between the first and the third candle, so the high of the first candle and the low of the third candle. And in this case, you would put your limit at the low of that third candle. And so this next setup is an interesting one because what we have is we have our fair value gap formed here. And now this isn't quite as accurate because ICT uses a 1-minute chart to show this, but it's still valid in terms of what happens in terms of price action afterwards. So we have our fair value gap formed, and again, it's our 3 candle setup. Fair value gap is between the first and the third candles, and you'd have your stop at the low of that first candle. Now we have a short-term low that's formed here. Now, if you missed this actual entry in terms of getting set on this particular setup, the market trades back lower again. And so what that enables you to do is to use the previous short-term low, because this is obviously a breach of that short-term low, as your entry point. So you could set your entry here and again still have your stop down here, and that's just going to give you a much tighter entry, which obviously gives you a much better risk return. And then the third entry, you can see we've pretty much got 3 flavors of entry in terms of this afternoon session, is again we have a fair value gap, and this is traditionally what we'd want to see, is where we have this short-term high, the second candle which breaks market structure. So we again have our 3 candles set up, our fair value gap formed in between, and we've got our order block entry. So we have these consecutive down close candles, and then we'd use the open of the first candle in that sequence as our limit order to buy in terms of in that fair value gap. You can see the market trades back into it before trading higher. So you can see over the course of the session, we had multiple opportunities to get set, and each of these opportunities actually presented a different methodology for entering that long trade. I hope you enjoyed my review of ICT's 2022 Mentorship Program Lesson 9. In today's video, we covered the Power of 3, specifically looking at the bullish version of the Power of 3. I'll do a separate video on the Power of 3 and go into that in a lot more detail in another video. And then we applied the Power of 3 to a couple of different sessions, and specifically using the afternoon session. So I hope you enjoyed this video and I hope you learned something from it. If you did, it'd be great if you could like it. That helps other people to find it. And if you enjoyed this video, make sure you subscribe to my channel. Thanks for watching, and I'll see you in the next video.